Hello, everyone, and welcome to Zonda's third quarter housing outlook. Today's focus is on Washington, D.C. and the surrounding metros. I'm Allie Wolf, the Chief Economist for Zonda, and I'm joined today by Dan Fulton, Zonda's Senior Vice President of Advisory and Northeast expert. As mentioned, we are Zonda. We are a housing data and consultancy firm. We track the entire building life cycle from raw land up until the closing out of new home communities. Through our data, we can inform on market trends and offer solutions to builders, developers, mortgage lenders, building product suppliers, and more. Our data enables us to provide custom solutions. Our advisory team, led by my partner in crime, Tim Sullivan, works on lot and product segmentation, pricing and absorption analysis, and consumer and product research across the country. Don't forget that Zonda Advisory is here to help. Another way we inform on market trends is through our market snapshots. Every month, we produce a report highlighting essential housing insights for the top 65 metros. Get your free local report today at zondahome.com/market-snapshot. If you were involved in or curious about the built-to-rent and single-family rental space, know that we just launched a new report. Our rental housing outlook provides a deep dive on the rental market, including a built-to-rent index, capital market survey results, and forecasts. Again, you can learn more at zondahome.com/rental-housing. Livable is Zonda's reimagined listing service. Livable is changing the way consumers are looking at new homes. This free listing platform connects consumers to the new home market in an intuitive, comprehensive, and aesthetically pleasing manner. You can create your own free listing today at livable.com. Now, conference season is picking back up, and we'd love to see you in person. Check out our multifamily executive conference in Dallas in September, Future Place, focused on the future of master plan communities in Tampa in October, and our brand new event, Elevate, where we'll discuss the art of high-rise living in Miami in December. Finally, today's event would not be possible without the sponsorship from Fund That Flip. Thank you, Fund That Flip, for your support. Matt Rodak, my friend and the CEO of Fund That Flip, founded the company out of frustration with the status quo of slow, unreliable capital and gatekeeping into investment deals. Today, they're one of the fastest growing real estate fintech companies in the US, with a focus on rehab, new construction, and portfolio loans, with competitive rates and the fastest close in hard money. They also offer business solutions, including rehab and rental analysis, comp stats, and contractor management. Learn more at fundthatflip.com. And thank you again to Matt and the team at Fund That Flip for sponsoring today's event. Now, with that, let's get to the agenda. I'll give a quick state of the housing market update for about 15 minutes before Dan will dive into DC and the surrounding metros. Now, where I want to start with my national presentation is by acknowledging the clear headwind, the headwind that we've been facing now for over a year. That depending on the day, we're looking at interest rates that are in the high sixes or the low sevens. And when you combine these higher interest rates with home price appreciation, we're still looking at a 50 to 70% change in the median monthly mortgage payment just since the beginning of last year. Now, as you look at numbers like this and you look at an affordability challenge like this, I think a natural next thought is that, okay, well, sales must be down because that's a huge affordability shock. And they are. If you look at existing home sales, the largest share of overall activity, sales are down year over year and compared to 2019. In fact, the most recent data for June showed that existing home sales were at their slowest pace since January. Now, part of the slowdown in sales comes down to rates and affordability. Part of it comes down to consumer confidence about the economy and the wider housing market. But I'd say a lot of it comes down to what's happening with inventory. Because again, if you look at listings nationally and locally, there are some instances where listings are above where we were last year. But if you look compared to 2019, we have most markets down 20, 40, 60% compared to 2019. And even in 2019, we were saying the lack of resale inventory was limiting overall transactions. It makes sense that the problem's only gotten worse since, though. We have people that are looking around, they're not seeing something else that they want to buy, nothing compelling, so they're staying put. Maybe they're remodeling. Maybe they're turning the home into a rental. But the most important thing is that we know 90% of people that have a mortgage have one under 5%. When they're looking at a maybe 4% interest rate and saying, why would I reset a 4% interest rate to 7%? But that's not to say there aren't still housing transactions. There aren't still people that are out looking for homes, because we know that there are. And what we're finding is there's this big divergence between the resale market and the new home market. As you look at our Zonda data for new home sales, think back to what we said on resale. Resale, June was the lowest since January. If you look at our new home data, we've just seen growth throughout this year. We're well above where we were in 2019. Many of you know we use that as our healthy year for comparison. But the key thing is we're also well below where we were during the height of the market. You can see it all right here. As we look at this, though, to see that sales have continued to grow this year, it really seems counterintuitive. Because since last March, the Federal Reserve has been raising short-term interest rates. And as they raise interest rates, they're trying to impact, in large part, some of the most interest rate sensitive sectors of the economy, housing being one of those. So to see sales actually growing feels a little bit confusing. Well, one key thing to remember is we absolutely saw the demand response last year. In 2022, across most markets in the country, we saw a very notable pullback in sales. But what happened was this unintended consequence where today demand is absolutely down from where it was at peak levels, but supply has come down even more. And we know from the new home community, it's been good because we've been able to gain share. New homes represent 30% of overall inventory, a historic unprecedented level. And those that have inventory today have the advantage. So as many of you know, we like to look at the total sales number, but we also like to look at the average sales rate. If a builder has homes to sell, how well are they selling? 3 comparison points here: 2019, healthy year; 2021, height of the market; and current. What we're finding is that many markets are actually above where they were in 2021, including Baltimore and DC. I think the important thing to think about is in 2021, though, the market wasn't actually operating at its full capacity. Builders were intentionally capping sales. So by trying to compare to 2021, it is a little bit of an apples to oranges comparison. My key takeaway here as we look at this data is most markets across the country are not only outperforming 2019 modestly, but are pretty strongly outperforming that healthy pre-pandemic level. So as sales have exceeded expectations, as our biggest competitor, the resale market, has left the game in a lot of markets, what we're finding is that builders have pricing power. And what we saw in July is 44% of builders were raising prices nationally. It was 40% in the Mid-Atlantic. Now, if you're like me and you see that builders are raising prices, and by the way, we've known they've been raising prices throughout this year, it's a little bit nerve-wracking because we know part of the reason we got into this problem of slower demand last year was because of the affordability constraints and because prices got so high. I think the important thing here is if you compare today's price increases to the height of the market over the past few years, in the past, we were looking at $10,000, $20,000, $30,000 price increases. Now we're looking at more modest, $1,000, $3,000, $5,000. Builders raising prices a bit, but also having a lot of caution about not trying to get over our skis, not trying to rush these price increases, especially when it is blatantly clear that the issues today come down to current mortgage rates and overall home prices. In fact, if you look at DC and Baltimore, we've seen over 40% home price appreciation just since 2019. That's many years worth of appreciation before the pandemic kind of squished into just a handful. Now, as we look at this, we know consumers are trying to figure out how to adapt. Consumers are saying, okay, well, will I look at a home that's further away? Will I go again outside my search radius, look at a smaller home, look at different kinds of loan options? We know that consumers are doing their best to adjust because there still is this innate desire to convert to homeownership if they're renting right now. But we know builders are also doing what they can to adjust. As we ask in our survey, we ask builders about what kind of product changes, if at all, they were doing to their homes to help adjust for overall housing affordability. We had 25% of builders that were saying they were paring back their features. We have 37% of builders that are saying they're not making any changes, and it's because of the focus of their buyer. They're saying our buyer is someone who is expecting a nice product. If they're coming into the new home side, if they're paying top dollar, they want to have all the best features. And so they're keeping their product the same. But we have 38% of builders that are saying they're looking at smaller homes. And compared to pre-pandemic times, we've seen nationally home sizes have gone down 10%, and the DC metro home sizes have gone down 12%. Now, know that this stands in direct contrast to what was believed to have happened. We know that for a short period of time, homes were getting a little bit bigger to adjust for the work from home and the pandemic trends. But now what has become more powerful is, can people afford to buy homes when we know that that demand pool is so large? And I think that's the key thing. When you're looking at affordability, there's really no way that I can cut it to make affordability look good. And yet we are seeing some buyers that are out shopping. We are seeing in the new home side, the sales are outperforming expectations. So why? Why are buyers shopping in particular at new home communities? Number one, lack of resale supply. And this is one of the pronounced tailwinds that I don't think will be as severe once interest rates come back down, but I do think we should expect resale inventory to be lower for longer, given even if rates went down to 5%, you still have a lot of people who have locked in at 2% and 3% interest rates. But besides that, we have relocating, having children, downsizing, marriage, divorce. All of those that fall into what we're calling the life happens housing market, that almost regardless of what happens in the broader macro sense, marriage, divorce, relocating, retirement are some of those key structural demand factors that are a life stage catalyst that often prompt a move. Now, those would be the structural demand. And I said earlier that demand is down from where it was. That's because we're not driven as much today by fear of missing out buyers. We're not driven as much today by investors, by buyers on the margin that people just want to move. We're back to life happens. Now, as we look at all of this and we talk about affordability and we talk about that mobility is very low right now, but there's a lot of pent-up demand out there. What we know is more building can help with getting supply and demand better in balance. What you're looking at here is our second quarter housing starts activity by metro. This is an annualized basis. And so as you look at this, most markets down pretty notably compared to last year. But know that when we're looking at this data set, fourth quarter of last year and first quarter of this year are really the culprits to keeping these numbers down. As we look at how the year has progressed, we've seen each month builders become increasingly more confident. Each month, builders going to get more permits, that prerequisite to starts. And we know qualitatively from our survey that builders are more enthusiastic about starting more homes this year. So there's the focus on, okay, now's the time to strike. There's not much resale inventory. We can gain the share. Let's try to bring homes to the market soon. But let's also try to backfill for what our future success looks like as well. When we think back to December, we basically had no builders saying they were full steam ahead on land acquisition. As of July, it's 44% nationally and 40% in the Mid-Atlantic, saying full steam ahead. What's happening though, is again, last year, what we were seeing is land prices were flattening to going down. Now what we're finding is land prices are flattening to going up. And as we look at the land market, there are some comments in our survey that really stand out to me, kind of keep me up at night kind of comments. Land prices are skyrocketing and out of control. Every deal is multi-bid and underwriting is unjustified. The land market is overheating, with publics winning on deals with aggressive underwriting assumptions. We know that if the whole discussion is how do we build something that's attainable and reasonable to the market, when you have land prices going up and some of these comments come into fruition, land represents, depending on the market, 20 to 50% of that final home cost. So we're watching that. But as we go into our forecasts, if you have followed our forecast recently, you're going to see a very pronounced improvement to our forecast on the single family side. Right now, we're expecting total starts to be down 15% year over year. That's including single family and multifamily. Now, for multifamily, we have left this number untouched. We're really debating the idea that on the ground, multifamily organizations that we're talking to and leaders at those organizations are saying that 410 feels way too high compared to what they're seeing on the ground. Government data from the census is telling us that our 410 is way too low. And so we're trying to not necessarily match the census, but get closer to what we're hearing on the ground, but having a little bit of data to back that up. For single family, we have just seen such an outperformance compared to our original expectations that we've bumped this number up. What some of you know is the way that we come to our forecast is we have a quantitative model that will give us a number. And then there's five economists that meet and we say, hey, what do we think about this number? Do we think that the model knows the truth? Do you think the model knows what's happening on the ground? How should we revise it one way or another? So we've revised single family up, but as many of you know, we also always are asking ourselves the questions. What could make us too positive? What if we met again in a handful of months and starts were actually down 30%? What would be the driver of that? Well, we're assuming that the affordability challenges at least level off as we have the incentives that are available by the builders, and with all hope, we don't continue to see mortgage rates rise much higher than where they are today. We're also assuming that credit market conditions tighten, but don't get too dramatically tight. And if we're wrong there, then I think our forecast may be, hey, builders want to build homes, but it may be difficult to do so given credit standards. But what about us being too negative? What if we meet in a few months and starts are actually down 2% compared to last year? Well, we know that the market has shown way more signs of life than originally expected. And when we met just a couple quarters ago, I had said, housing slows before the rest of the economy. Housing comes back before the rest of the economy. We have seen that, at least on the new home side, that we're past that bottom. In fact, we came out about 6 weeks ago and said that the recession in the new home market was over. We do not believe we're no longer receding to grow less. We saw that prices were going up, starts were going up, sales were going up. That's what gave us confidence to say that, and that it had happened for many months throughout 2023. But the key question is that it? Are we back for good? And there are still some pretty big risks in the economy that we're trying not to ignore. The Fed, we may see another increase. There's a long and variable lag. We just got new data this week that credit standards across the economy is tightening even more, and banks expect to tighten them even stricter throughout the rest of this year. Huge risk that we need to pay attention to. Consumers still spending, but putting more money on credit cards. That's a risk. The office market, I think this is the very clear elephant in the room where everyone knows there's something scary going on there, but no one can exactly quantify it. We're still watching that. And all of these pose the risk that we could fall into some kind of double dip housing recession. But as we're looking at the market, we know that we're trying to make decisions about over the next 3-6 months, but we're also trying to make longer term, medium term investment decisions. And we believe the medium term runway is so incredibly solid for housing, but there needs to be this focus. One, back to fundamentals. How do we better align home prices and incomes? Because the markets that had their home price to income ratios get so out of whack were the markets that got hit the hardest when interest rates went up. That's a core part of having a healthy and sustainable housing market. And if building attainable entry-level first move-up homes is not your jam, we also need to think about how do we create something compelling that someone has an interest rate, they're okay in their home, they don't have to move, but they see the community, they see the product, they see the location, and it makes them want to move. I think that becomes so important and such a big weight on the shoulders of our industry. Now with that, I'd like to introduce Dan Fulton, Zonda's Senior Vice President of Advisory and Northeast Expert. Dan's going to go through the Washington, D.C. market overview. And I'll say this is my first national presentation with Dan, and it's a bit of a blast from the past. Dan and I used to work together nearly 10 years ago at a previous company. If you don't know Dan, he did his first market study in Reston back in 1987 and has worked as a builder, developer, and consultant ever since. I learn something every time I talk to or listen to one of Dan's presentations. So I'm excited to pass the virtual stage to Dan Fulton.
Well, thank you, Allie. I appreciate that kind introduction. And yes, it's been 36 years since I've completed my first market study for Ryland Homes in Reston, Virginia. Polo Club Village was the name of the community. So today we're going to look at the Washington housing market in detail. But in addition to that, I'm going to highlight some of the metropolitan areas surrounding Washington that are seeing significant activity, both for the positive and for the negative. We're going to look at Baltimore, which has seen a significant decline in actively selling projects. We're going to see talk about Richmond, which has seen an increase in attention from public builders looking to expand. Virginia Beach and Norfolk is a self-contained, defense-oriented economy that is a pretty active housing market. You know, the coast of Maryland and Delaware, the Salisbury, Maryland, Sussex County, Delaware, is an incredibly active housing market focusing on retirees. And then you have this charming town of Charlottesville that's just south, an hour and a half south of DC, that has its own economy and thrives on being so close to the nation's capital. But let's first talk about Washington. And this really is a fascinating city to live in, to work in. It's so dynamic, and there's so many different components to the DC economy that it makes the individual submarkets really act independently. You know, we have a fantastic infrastructure. We have 3 major airports serving the DC and Baltimore. We have a world-class commuter rail system called Metro that really does a fantastic job at linking the suburbs and the employment centers. We have one of the highest educated workforces in the country, third behind Ann Arbor and San Jose. So for a major metropolitan area, it probably has the largest or the highest educated workforce. But most importantly, it's the seat of federal government and the institutions of federal government that carry and hold such amazing, massive budgets. And those budgets filter into our regional economy. And that's why the DC market area is so impressive and buffered from economic downturns. So why is it buffered from economic downturns? Well, first of all, let's go and talk about the independents. So you have the Virginia and Maryland. You have 2 very distinct markets within the within the Washington MSA. If you look at Maryland, you know, you're talking about life sciences. It's driven by the proximity to the National Institutes of Health in Bethesda, the FDA in Montgomery County, NASA in Prince George's County. And those anchors bring to you major pharma, major bioscience firms, other defense contractors like Lockheed Martin. And it's a very attractive place to live. You have Marriott has its world headquarters in Bethesda. But it's also a military space and national intelligence economy driven by Fort Meade, Joint Base Andrews and the National Security Agency, which is located on Fort Meade or adjacent to. So that's what's driving the Maryland economy. The Maryland portion of the DC Metro. But in Virginia, it's a defense-oriented economy. So you have life in Maryland and you have defense in Virginia. And you have a major technology presence. And for a large reason for that is that it's a very business-friendly state, ranked #2 business-friendly state by CNBC. Again, as mentioned before, we have an excellent infrastructure. So it's easy to get around. Traffic we are a congested metropolitan area, but it's alleviated significantly since COVID. But Metro serves many of the largest suburbs. Because you're so close to the Pentagon, the CIA, the FBI. I mean, you have major defense contractors that make Washington its headquarters. Raytheon, Leidos, Northrop Grumman, General Dynamics, all of these companies are headquartered in the DC metro area, as is other corporations. Capital One just moved here from Richmond. Hilton Worldwide, Amazon HQ2, as mentioned earlier, has a headquarters location in Virginia. So these two markets together make an incredibly dynamic economy. As mentioned earlier, we are buffered from economic cycles. And why? We have nearly 370 federal employees in that make up about 13% of the Washington workforce. Now, this federal employment, it's grown over time, but it has changed by administration. And you can see in this chart in the administrations, the Clinton downsizing of the federal government really had an impact on the housing market in the mid-90s, really flattened out the housing market. But the Bush run-up and the Obama dealing with the financial crisis, you saw federal employment increase. But for the most part, it holds steady, and it serves as really a strong buffer to economic swings. But in addition to the federal employment, you have defense spending. Now, this has a major impact on the local economy, and primarily the discretional defense budget. Currently, we're at about $753 billion budget. That's been submitted for 24. And we have to understand that it's not the size of the budget that's important. It's the change in the budget that really drives housing. If you look at the Bush administration and the run-up to we were in multiple wars, you saw a significant increase to the defense budget in that 2002 to 2008 timeframe. And we saw we had a major, a strong housing market, similar to what we saw back in the Reagan years when the DC suburbs were being built by those like Kettler and Van Meter, where Reagan increased the budget substantially. So it's that change in defense spending that really drives the economy. We expect the Biden administration to have minor, small changes, small increases, as has been shown the last couple of years. So nothing major is going to affect, but what's important is that we don't see a decline in the future. So let's look at the housing market conditions for the DC metro area. So there are 328 actively selling communities in the metropolitan area, and that represents a 49% decrease in communities from 2015. So this is a story that's being told across the country, the shrinking of the actively selling community inventory. But what's also important to understand is that the mix of types of projects, the mix of product type has changed as well. If you look at this chart, the blue columns are the blue color represents single family detached, where the orange represents single family attached and condominium, so all attached product. In 2015, the DC metropolitan area had roughly 38% attached product, and there were 62% single family detached. Currently, we are at 59% attached product in the metropolitan area. The area is becoming much more dense, and development is becoming dense. Condominiums are being built in far out suburban locations where you typically wouldn't see condominiums 10 years ago. So it's an interesting point, and we expect this to continue for some time. As far as builders go, NVR dominates the local market with 22% market share with Ryan, and if you combine Ryan Homes and NV Homes. And this information is year-to-date sales, so 6 months worth of sales. Want to point out, of the top 10, 2 of the builders, Stanley Martin Homes and DRB Group, are equity-backed builders. So those act somewhat like a public builder. You have one, the powerhouse, one is self-funded, and that's the powerhouse builders, Van Meter Homes. And then the rest on this list are public builders. I want to point out something with Ryan Homes. 835 sales year to date, 35 active projects, selling 6 homes a month. That is an amazing pace, and it's one of the reasons why they dominate the markets in which they're located. And later on in this presentation, we're going to look at 5 other markets in addition to Washington, and NVR dominates all of them, #1 market share. So public builders, since the COVID pandemic, have significantly increased their market share in the DC area from roughly 48% in 2020 to 62% in 23. We attribute much of this to land grabs and the quick move-in strategies that have worked well for the largest home builders. We've seen the sales pace on a per project basis flatten out nationally. This chart shows you the Washington DC market and against the national market in purple. While the national market has flattened, we've seen the DC metropolitan area, the sales pace drop slightly. Not to be concerned, but we've seen it slow down slightly over the last couple months. So I dug down into the sales pace and the average sales rate by county, and looking at over the last 12 months. And there's a couple of trends became clear I wanted to point out. For one, the top counties are selling on average 3.5 to could be 4.5 sales per month in Manassas Park City, a very small submarket, but it's a very active housing market. But if you look at the core there, the outer markets, you're looking at Charles County, Frederick County, Virginia, and Jefferson County, West Virginia. The Frederick and Jefferson are essentially in the 81 quarter. This is a distant suburb of the DC metropolitan area. And then you have Prince George's County and Fredericksburg City rounding out, the top selling markets. So those are outer markets, more affordable. The core markets and others make up the next tranche of by sales rate, and you're looking at those are selling roughly 3 sales a month, and that's the core markets. Loudoun, Prince William, a couple mixed in there include Spotsylvania, which is a distant market, but for the most part, these are core markets that are seeing roughly 3 sales a month, and then others that are very small markets or highly competitive markets are seeing in the 2 to 2.5 sales a month. But I see this as a very strong absorption pace overall. From a price standpoint, your average new detached list price or base price on the DC Metro is $764,000 for an attached product. The average price is $605,000. Now, the average attached home, there's a variety of product types that make up attached housing in this market area, ranging from very affordable townhomes to high-end $1 million townhomes in Loudoun County. So there's a lot of product differentiation in the attached product. And from an existing home standpoint, your detached homes close price roughly $689,000. And the attached homes median close price is $450,000. So what I like to point out here is that the rate of growth for the median and the detached and attached existing homes is much more rapid than the attached homes. So we're seeing a little bit of tightening between the resale home and the new home pricing. Prices are continuing to rise in the Washington MSA. You see two lines on this chart. One is the base price growth for the Washington MSA as defined by the census. And the other is the Washington market that we've defined for this presentation that includes other adjacent MSAs of Hagerstown and Winchester, largely along the 81 corridor. And it's interesting to me that if you look at the core Washington MSA, the pricing has continued to increase pretty steadily over time, whereas as soon as rates hit and the rates rose, you started to see a flattening of the base prices when you include the perimeter markets, telling me that that market may have hit a price ceiling during that period, and in order to maintain pace, and they've had to either drop prices or introduce more affordable product. Let's look at Case-Shiller and the appreciation rates for Washington relative to other markets around the country, primarily in the East Coast. If you look at the year-over-year appreciation rate for Washington, what you see is a very modest appreciation relative to other markets. At its peak, we saw a 15% appreciation in 21 relative compared to a peak in the 20 city index of roughly 20%, just over 20% in early 22. If you look at a market like Miami, that has experienced significant appreciation and relocation and influx of others, you see a significant year-over-year appreciation rate, roughly 35, just under 35% year-over-year. If looking at the month-over-month appreciation rate, though, and you've seen a modest decline, in August of 22, we saw home values drop 1.5%, but it rebounded from there, and we saw modest declines for the next few months. But recently, you see that we've seen appreciation rates roughly 1.5% for the metropolitan area for the last 3 months. So that to me is a strong indication that, number one, for the reasons Ali mentioned earlier, the market is rebounding. It's the inventory is low. There's strong demand for housing in general, and it's showing in the appreciation rates. Builders are starting to reduce their risk profile in 23. In the previous 2 years, we saw in this chart, we're looking at contract sales, closings, and starts, sales in purple, closings in blue, and starts in yellow. You can see that in the previous 2 years that the starts have really been well ahead of sales. That's changed in 23, where you see starts and sales really in line with each other. And that's telling me that the QMI strategy has been still active, but builders are bringing that in line to reduce their risk profile. Starts are up quarter after quarter for 2 consecutive quarters, but we're still down from the previous year. It's interesting, though, then in that next quarter, we expect starts to increase, and that would place us at a year-over-year increase over the third quarter of 22. But over the previous 2 quarters, the fourth quarter of 22 and the first quarter of 21, we saw an increase, and then we saw an increase leading into the second quarter as well. And you can see, looking at this at a rolling 10-year basis, a annual basis over the last 10 years, you can see how starts have really plummeted, to really a 10-year low recently. And we do expect that home closings will follow. Spec home inventory, we've seen starts fall, so therefore it's logical that the spec home inventory or finished vacant homes in Zonda speak will fall. And yes, they have. We are currently at roughly a 1.5 months of supply, which is lower than the 10-year average, and shows no sign of affecting the marketplace other than perhaps supporting more price increases. We looked at the annual sales by product type, or projects by product type earlier. I think it was the first slide I showed you in this section, and the sales support that as well. So in 2017, we looked at with roughly a little over 12,000 overall sales. 52% of those were for attached product. And over the years, the number of attached sales has really increased as a percentage of total sales. And today, similar to what we saw for the the active project list, we're at roughly 61% attached sales in 23 year to date. As far as contract sales go, you can see how the sales rate has decreased 15% in 21. 20% in 22, and we expect probably another slight decline, perhaps 10% in 23 when all said and done. So where are sales happening? So Prince George's County leads the charge in the number of sales, contract sales by county for the last 12 months. Followed by Loudoun County and Frederick County, Maryland. So we have two Frederick counties in this region, Frederick County, Maryland, and Frederick County, Virginia. So Frederick County, Maryland, on the backside of Montgomery County, has been a very active housing market. Berkeley has been a very active housing market, very competitive market as well, in a price constrained kind of way. And then Prince William and Charles round out the top performers for contract sales. But it's interesting to see where sales are changing. I'm going to start at the bottom of this chart first. Look at the difference in sales. This chart shows you the change in sales over the last 12 months. So the 12 months ending July 22 and the 12 months ending June 23. The change in sales, Frederick County has lost nearly 700 sales year over year. And then Montgomery County over 400 sales, and Loudoun County almost 400 sales. So these core markets are seeing significant drop in actual sales numbers. Spotsylvania County, which is to the south, has seen a drop as well. But the improving housing markets, Jefferson County, West Virginia, which is in the 81 corridor, which is the interstate that goes through Western Virginia. Charles County, Maryland, which is south of Prince George's County, about 45 minutes south of the city. And then Frederick County, Virginia, again, and it's this Winchester area. So this area is seeing significant activity along with Charles County, whereas declines are being seen in the core markets. Supply highlights, in terms of future lots, the DC metro area has 171,000 future lots, many of which probably will not be developed, but we're looking at over 12,000 vacant developed lots. And this is an improving number, up 49% year over year. Lot deliveries for the quarter and quarterly starts are lot deliveries somewhat beating quarterly starts, and that's a good thing. And that allows us to get the vacant developed lot inventory up a little bit. We have over 8,300 homes under construction. 1,400 of those are finished vacant, and that's a 22% drop from last year. So improving inventory information or numbers, which is positive for the overall housing market. But when you're talking about land in Washington, D.C., this is where we are concerned. If you have land, it's gold. And so it's important that you plan it properly because DC is a significantly undersupplied market. Yeah, along with Baltimore, these are two of the lowest supplied land markets in the country. It's a point of concern. So it's showing improvement. But what this does is it essentially removes the risk of oversupply from your risk profile when you invest in a property. The lot supply, vacant developed lot inventory and annual housing starts is what we're seeing on this chart, leading to the vacant developed lot months of supply or finished lot months of supply. Again, we improved from just under 8 months of supply to 14 months of supply over the recent months, and that's been a very positive movement that really is making us a healthier housing market. But that is due largely to slower starts activity. While that number continues to improve, the vacant developed lot inventory in the closer in markets, the core housing market, continues to be low from right in that 7 to 10 month range. Loudoun County here, 20 months worth of inventory, that's strong. Stafford, 17 months of inventory. That's good. I mean, that's heading in the direction we want to see. But Prince William at 10 months of inventory, that's still low. And all these in less than 10 months of inventory, really, we need to push that inventory up. The inventory of lots by price range is improving significantly. If you look at it look at the core DC metropolitan area price ranges, which are essentially $400,000 to $700,000. You're looking at 35% increase year over year in that 400 in the 400s, 80 to 90% increase in that $500,000 to $700,000 range. So this is a significant increase to your lot supply in the core part of the DC pricing structure. In terms of lots under construction, where are they being delivered? Prince George's County by far is the most active development environment, followed by Loudoun County with nearly 4,000 lots. And Montgomery County, surprisingly, is strong with over nearly 3,000 lots. Berkeley County is an interesting county because it's had and this is West Virginia, they had a significant amount of approved and partially developed communities in which they're developing today. And so many of the roads or many of the projects and lots to be delivered are really undergoing paving right now with very few. So these will be delivered more in the near to mid-term. So let's take a look at the smaller markets. From Washington, you can get to Virginia Beach and Norfolk within 3.5 hours. Salisbury, Sussex, the coastal markets within about 3 hours. Baltimore's next door. Charlottesville is about an hour and a half, 2 hours away, and Richmond's about an hour and a half away. So all of these markets are interesting to investors and builders because they're so close to Washington and can be managed. If you're a home builder, you can manage these from the Washington market. They all have their unique economies and demand drivers, but Washington and Baltimore are largely federal oriented. Richmond has a corporate, very attractive corporate location, headquarters to CarMax, Altria, which was the former Philip Morris, Genworth Financial, and it has a Federal Reserve office. It's a seat of federal state government, and it's a significant healthcare environment in Richmond as well. Virginia Beach, largely a defense-oriented economy. Salisbury and Sussex. It's a retirement destination and a tourism market. And then you have Charlottesville, which really, because of its proximity to Washington, is a strong federal defense department, defense economy, and a strong, of course, education economy with UVA. Sorry, backwards. The economies of these markets really have improved since pre-COVID, and we look at the number of highly paid jobs relative to the pre-pandemic. And you look at Salisbury, which are the coastal markets, and what we're seeing here are a lot of people moving to Salisbury and Sussex County for a work from home environment, bringing these high wage jobs with them. Charlottesville and Richmond have performed well, 6% to 7% above the highly paid workforce pre-pandemic, and then Washington at 2% above, followed by Virginia Beach and Baltimore, which are essentially at the same level of highly paid workforce relative to the pre-pandemic. Permit activity is as a mixed story here. There are 3 markets that are seeing significant growth. Richmond, 26% growth permit activity from 2013 to 2022. Salisbury, a 20% increase over that 10-year period, and Charlottesville, a 12% increase. And the increase is probably more significant since your pre-pandemic period, where you saw the significant uptick in permit activity in these markets. Baltimore and Virginia Beach, on the other hand, are seeing either flat or declining activity over that 10-year period and since pre-pandemic. So let's look at permits then by household. According to the chart here shows permits per 1,000 households in 22, and the number. So this shows you that 28 total permits, including multifamily and single family product, were issued for every household, 1,000 households in Salisbury. And this demonstrates the growth of these markets. If you look at Washington, it's right in line with the national average, 13 permits per 1,000 households. Look at Salisbury, 28 permits. Richmond, 19. Even Charlottesville shows strong, and these demonstrate these 3 markets as growth markets, whereas Virginia Beach at 9 permits and Baltimore at 6 permits. These are supply constrained and tighter housing markets in these locations. In terms of home value appreciation, this is a busy chart, but let me quickly explain it. These are the top 25 markets plus the 5 markets that we're discussing here today. It's ranked by year-over-year appreciation utilizing Zillow Home Value Index. And we've also looked at the COVID era, so the appreciation that these markets have seen since pre-COVID. And Miami comes in number 1 with 6% of year-over-year appreciation and 56% appreciation since January 2020. So that's a rock star market, and we see why why it's done so well. Washington, D.C., I'll bring you down here, has a modest home value depreciation, and it's one of the lowest appreciation rates for since pre-COVID at 26%, according to Zillow. But look at the other markets that we're talking about here today. Richmond comes in just below Miami, again, 6% appreciation with 42% increase over pre-pandemic. And I'll bring your eyes to Salisbury, Sussex. Again, a modest but reasonable 3% appreciation and one of the highest appreciation rates since pre-pandemic. So you can see the strength of these markets that are surrounding DC. Baltimore, again, similar to DC, had one of the lowest appreciation rates pre-pandemic, but but that is largely due, as with many of these markets, due to the lack of inventory. As with most of the markets around the country, the bottom tier of the product sets are the are seeing the most appreciation, followed by the middle tier, where the top tier price points have been struggling. In terms of active projects, we talked about Washington earlier, 325 projects compared to these other markets that are all reasonably supplied markets with 77, 65 to 110 actively selling projects. But again, like we did with permits, let's look at the number of active projects per 1,000 households, per 100,000 households. Richmond, again, a growth market, has 20 active projects per 1,000 households, 100,000 households, compared to Washington at 13 projects. Look at Salisbury and Sussex, 55 actively selling projects per 100,000 households. So that's a major difference from these other markets, but it's right in line. I provided a Myrtle Beach number here for you as well. That's right in line for a coastal market that focuses on retirees. It brings people in from elsewhere. That Salisbury, Sussex, it fills the need for retirement from not only the DC, Baltimore metro areas, but also the Philadelphia and New Jersey and New York metro area. So it's really a fantastic housing market. So let's wrap this up. I have 4 minutes left. We think the housing market in the DC metropolitan area is going to remain volatile as rates continue to rise. But we do see a soft landing as has become more likely. And as Ali mentioned earlier, many things can happen here that may affect this outlook and increase the risk of a double dip housing recession. New home sales will improve as resale inventory remains tight. We think, as we're seeing nationally, the new home share of market will continue to improve once rates start to drop. So migration to the outer markets will continue due to price pressures of the closer markets in the work from home trends that we believe will continue. The markets along 81, the Interstate 81, south past the area between Richmond and DC are very much in play, and the Eastern Shore very much in play. Home value appreciation will remain modest as rates remain high. We do see increasing appreciation rates potential once rates subside, but as with DC in general, it's going to be more moderate than the rest of the country. As far as markets, the smaller markets to focus on, I think Richmond and Salisbury and Sussex County will be your solid growth markets to focus on. The other markets, I think there's a little bit too much risk right now, and increasing issues that have resulted in lower lot supplies. So I want to thank you all for your time today and your attendance. And I really want to thank Fund That Flip for sponsoring this presentation. Fantastic company that's serving a distinct need in the marketplace. I want to remind you that a recording will be available for you on zondahome.com once we finish here. And we have a QR code for you as well to scan. So please scan this QR code and subscribe to our emails and provide any feedback you want to provide about this presentation. Once again, I want to thank you all for your time and attention today, and I hope you have a great day.